To understand how the economy works, we use a simple diagram that helps us understand the sectors of economy and how they interact with each other. This model is called the circular flow model. There are 5 sectors of the economy: firms, the financial sector, the overseas trade sector, the government, and households. There are 14 flows, 10 money flows and 4 real flows linking between sectors. Money flows show the movement of money between sectors, and real flows show the movement of physical resources. All the 4 real flows have reciprocal money flows. This means that they are equal. As one goes up, so does the other. An easy example would be when firms supply goods and services in response to the flow of households spending money.
In New Zealand, shops and businesses are also known as firms. There are 3 types of firms: primary, secondary, and tertiary. Primary firms, such as fishing or farming, collect and harvest raw materials. Secondary firms take the raw materials the primary firms have collected or harvested and refine or process them so they are able to be sold. Tertiary is the biggest section. They are the businesses that help people, such as doctors or lawyers. An example of something that starts at a primary firm and ends at a tertiary firm is manuka honey. It is collected by the beehive keepers, then it's sent to be processed, and finally it is sold in the supermarkets. The firm sector has 11 flows which link to every other sector in the economy. The first set of flows are the supply and demand of goods and services, which are flows connected to the household sector. These 2 flows are reciprocal as they are always equal in amount. What you ask for, you get, not any more or less. Demand of goods and services is a money flow when a customer pays the company for goods or services. The supply of goods and services is when the business gives the product to the customer. For example, at McDonald's, you ask for the food or demand for the goods. Then the worker hands over the food, supplying the goods. The supply of goods or services is a real flow as actual goods are being exchanged. Another set of reciprocal flows between the household and the firm sector are the factor incomes and factors of production. Factor incomes are what households earn from firms, in the form of rent, wages, and profit. Factors of production are the inputs that households put into firms, such as land, labour, or capital. The next 2 sets of flows associated with firms are both to and from the international trade sector. These are imports, import payments, exports, and export receipts. Exports and export receipts are reciprocal flows, as are imports and imports payments. Exports are a real flow of goods and services. Goods and services are produced in New Zealand, then exported and sold overseas. The payment received for the goods is called export receipts and is a money flow coming into the firm sector. Imports are also a real flow of goods and services that have been produced overseas then imported into New Zealand. Import payments is a money flow going out of firms as payment for the imported goods. The last 3 flows connected to the firm sector are all autonomous. The first one is firms undertaking investment, which means they are taking out a loan from the bank to expand their business. Another autonomous flow associated with firms is profit tax, which is money flow representing the percentage of a business's earnings that are collected by the government. The last flow for firms is government expenditure. The government will pay firms that provide services for all taxpayers, such as public libraries, hospitals, and public education.
The next sector we will be looking at is the government, or public sector. There are 4 money flows connected to the government, 2 coming in and 2 going out. The 2 flows coming into the government are both tax payments. The first tax income for the government is pay-as-you-earn tax, coming from household earners, which comes from people that are earning money paying a percentage of what they earn as they earn. The more you earn, the higher the percentage that you pay is. The other tax coming into the government is profit tax. Profit tax is collected by the Inland Revenue Department from firms. The government spends these taxes in 2 ways, either transfer payments to households or through government expenditure. Transfer payments include superannuation, a payment to retired citizens over the age of 65, benefits, which are available to citizens that are unable to work, and social welfare. Government expenditure is spent on things like healthcare, education, justice, and transportation, services that benefit all taxpayers.
The next sector is the household sector, which has 7 flows associated with it. The first 2 flows for households are connected to the government. There is pay-as-you-earn tax and transfer payments, which have both been explained already. The next flows from households are all going to and coming from firms. The first 2 of these are the demand and supply of goods and services, and the other 2 flows between households and firms are factor incomes and factors of production. Another money flow leaving the household sector is savings that households put into the bank to store their money until they need to use it.
Households save money in the financial sector, or banks. The financial sector has 2 money flows, savings from households and firms undertaking investment. While it is acknowledged that banks pay interest on savings and firms repay investments, these are not large enough flows to be included on the circular flow model. Savings are put in banks by households hoping to earn interest on their money or simply safeguard it for the future. Firms can undertake investment from the bank, which, just a reminder, is taking a loan out from the bank to grow the business.
The next sector we are going to talk about is the overseas trade sector, also known as the international trade sector. The overseas trade sector has 4 flows connecting it to the New Zealand economy: exports, export receipts, imports and import payments, which have all been covered briefly, but this will go into a bit more detail. Imports are when firms in New Zealand buy in products or services from another country. New Zealand's biggest import is petrol, which is followed by machinery parts. Exports are things that we produce and are sold to other countries. New Zealand's biggest exports are dairy, mainly in the form of milk powder, and meat. Import payments and export receipts are both money flows. Import payments are paid by New Zealand firms for goods and services that have been imported into New Zealand. Export receipts are paid by firms overseas who have brought New Zealand's goods and services.
As you hopefully now know, the circular flow model is comprised of 5 sectors and 14 flows, and is a simple representation of the economy, helping us understand how wealth moves around New Zealand and to other countries.